Should you be worried about what America's debt means for your retirement savings? In one sentence, yes, because the national debt just crossed $38.5 trillion. Interest payments alone now cost more than $1 trillion a year. And central banks around the world, including right next door in Canada, are already quietly changing how they hold their money because of it. Stay with me, because by the end of this video, you will understand exactly what this number means for your savings, your retirement, and why the way Canada is responding might be the most telling detail in this entire story. Let's start with the number itself, because it deserves a moment of real context. $38.5 trillion. That is the total amount the United States government currently owes, and it did not get there overnight. The American economy, measured by total yearly output, sits at roughly $30 trillion, which means the debt has now climbed past the size of the entire economy, sitting above 120% of GDP, a level the country has only approached once before in its history, during the height of the Second World War. To put that historical comparison in perspective, the debt buildup during World War II happened over the course of a few intense years, financing an existential global conflict, and the country spent the following decades gradually paying that ratio back down through sustained economic growth. This time is different in an important way. There is no single dramatic event driving this debt higher, no world war, no singular crisis with a clear end date. Instead, the debt has climbed steadily, year after year, through a combination of tax policy, spending decisions, and rising interest costs feeding on themselves, which makes the path back down far less obvious than it was after the war. Here is the part that should actually get your attention more than the headline number itself. Interest payments alone, just the cost of servicing that debt, now exceed $1 trillion every single year. Not new spending on programs, not military spending, not infrastructure, simply the interest owed on money already borrowed. That is money the government has to find every single year before it spends a single dollar on anything else. And it is money that competes directly with everything else the federal budget is supposed to fund. To make that number tangible, $1 trillion in annual interest payments now rivals or exceeds what the federal government spends on entire major categories of the budget, categories that directly affect millions of Americans, including significant portions of national defense spending. When interest costs climb into that territory, lawmakers eventually face uncomfortable choices, either cutting spending elsewhere, raising taxes, or continuing to borrow even more to cover the gap, which only adds to next year's interest bill in a cycle that becomes harder to break the longer it continues. Now, before this turns into pure doom and gloom, it is worth understanding who actually owns this debt, because that detail changes the picture somewhat. Over 70% of the total debt is owed to lenders inside the United States itself, banks, pension funds, insurance companies, and everyday Americans holding treasury bonds in their own retirement accounts. The remaining share held by foreign countries is led by Japan, China, and the United Kingdom, the three largest external holders. So this is not simply a story of America owing money to hostile foreign powers. A lot of it is owed to Americans themselves through the very retirement accounts this video is asking you to think about. This distinction matters more than it might first appear. A debt owed primarily to your own citizens behaves very differently than a debt owed primarily to foreign creditors who could theoretically demand repayment on unfavorable terms or dump holdings during a crisis of confidence. But it also means the consequences of this debt situation land closer to home than many people assume, since a large share of the eventual burden, whether through higher taxes, reduced government services, or currency effects, gets absorbed by the American public directly, rather than being something that only affects distant international relationships. But here is where the story shifts from a domestic budget problem into something with global consequences. And it is the part almost nobody explains clearly. For decades, the United States dollar has served as the world's primary reserve currency, meaning central banks around the globe hold huge stockpiles of dollars and dollar-denominated assets, like American Treasury bonds, as the safest place to park their national savings. This arrangement has been enormously beneficial for America, since it allows the government to borrow more cheaply than almost any other country on earth, precisely because so much global demand exists for dollar-denominated debt. That arrangement is not collapsing, but it is eroding, slowly and steadily. And the data on this is unambiguous. The dollar's share of total global reserves has fallen to its lowest level since 1994, continuing a gradual decline that has been building for over 2 decades. Back in 2001, the dollar made up roughly 72% of global reserves. Today, that figure sits closer to 57 or 58%. That is not a dramatic collapse, but it is a meaningful, sustained shift. And shifts like this tend to accelerate once they build enough momentum, not reverse on their own. It helps to understand what has actually been filling that gap over the past 2 decades, because the story is not as simple as one single rival currency stepping in to replace the dollar. For a while, the euro looked like the natural successor, with European officials even discussing eventual parity with the dollar, until the European debt crisis beginning in 2009 stalled that momentum permanently. Since then, the shift away from the dollar has not concentrated into any single alternative currency, instead spreading across dozens of smaller, what economists call non-traditional reserve currencies, alongside a renewed embrace of gold, which brings no political baggage or dependence on any single foreign government. Here is what is filling that gap, and it tells you exactly how seriously the rest of the world is taking America's debt situation. Central banks are buying gold at a pace not seen in decades. According to the World Gold Council's most recent survey of central banks, 68% now plan to increase their gold holdings this year, up from 62% just the year before. Turkey added 45 tons in a single month earlier this year. China's central bank purchased 225 tons last year alone. This is not a handful of countries quietly diversifying. This is a broad, accelerating global trend of central banks treating gold as a safer bet than they used to consider dollar-denominated debt. The reasoning behind this shift, when central bankers explain it publicly, tends to focus on a specific advantage gold offers that no currency can match. Gold carries no counterparty risk, meaning its value does not depend on any government honoring its debts or maintaining political stability. A dollar-denominated bond is only as reliable as the promise behind it, but a gold bar sitting in a vault does not depend on anyone's promise at all. In an environment where America's own fiscal path raises legitimate long-term questions, and where sanctions and asset freezes have shown that even dollar holdings can be weaponized in geopolitical disputes, that kind of unconditional stability has become increasingly attractive to central banks managing national reserves. This is exactly where Canada enters the story, and it enters in a way that might surprise you. You might expect Canada, sitting right next door and deeply intertwined with the American economy, to be following the same playbook as everyone else, quietly buying gold as a hedge against American debt and dollar uncertainty. Canada is doing the opposite. The Bank of Canada currently holds 0 tons of gold in its official reserves. Not a small amount, not a token holding for symbolic purposes, literally 0. Canada sold off its entire gold reserve gradually, starting in the 1980s at a time when the country's peak holdings back in the 1960s would be worth well over $100 billion at today's prices. Think about the scale of that decision for a moment. Canada is one of the largest gold-producing nations on the planet, with a mining industry that extracts the metal by the ton every single year for export. And yet the country holding all that mining expertise and physical proximity to gold production chose deliberately and repeatedly over decades, not to keep any of it in its own national reserves. That is not an accident of history. It reflects a consistent policy philosophy that has held steady even as gold prices have surged and even as the rest of the world has swung dramatically back toward the metal. When asked directly about this in the past year, a Canadian Finance Department spokesperson explained the reasoning plainly, saying the government believes holding high-quality, interest-bearing foreign currency assets serves Canada's reserve objectives better than gold does. In other words, Canada looked at the same global uncertainty pushing dozens of other countries toward gold and made a deliberate, calculated decision to go a completely different direction, spreading its reserves instead across a diversified basket of major currencies, including the dollar, the euro, and the Japanese yen. Think about what that decision actually represents. While much of the world is racing toward gold as a hedge against exactly the kind of debt and reserve currency uncertainty we have been discussing, Canada is essentially betting that a diversified currency strategy, managed actively rather than parked in a metal that generates no interest, is the smarter long-term play. That is not a small technical detail buried in a central bank report. That is Canada explicitly positioning itself differently from the global herd on the exact question this video is about, and choosing to actively manage exposure to the dollar's uncertain future, rather than either ignoring the risk entirely or fleeing into gold the way so many other central banks have chosen to do. Let's talk about what this actually means for you, sitting at home, watching your own retirement savings, and wondering how worried to be. If you hold American Treasury bonds, either directly or through a retirement account, you are, in effect, one of the lenders keeping this entire system running. As long as demand for that debt stays strong, whether from domestic buyers or from the roughly 30% still held internationally, the interest rates the government pays stay manageable, and the system keeps functioning the way it has for decades. But every incremental step away from the dollar, every central bank quietly shifting reserves toward gold or other currencies, chips away slightly at that demand, and reduced demand for government debt eventually means higher interest rates to attract the buyers who remain. Higher government borrowing costs tend to ripple outward into higher borrowing costs across the entire economy: mortgages, car loans, credit cards, the kind of everyday costs that hit a fixed income the hardest. It is worth being clear about the timeline here too, since this is not the kind of shift that shows up overnight in a single bank statement. These changes in global reserve composition move slowly, measured in fractions of a percentage point over years, not sudden lurches from one month to the next. The danger is not a single dramatic event. It is the accumulated effect of many small shifts compounding quietly over a decade or more, the kind of slow-moving trend that is easy to dismiss in any single year, but impossible to ignore once you step back and look at the full stretch of time since the early 2000s. Let's talk about where this actually goes from here, because there are three realistic paths, and each one affects your financial security differently. The first scenario: the dollar's decline continues at its current gradual pace, roughly a percentage point or two of reserve share lost every few years, without any sudden crisis forcing a faster transition. In this scenario, American borrowing costs drift gradually higher over time, but slowly enough that the economy adjusts without major disruption. This is the scenario most mainstream economists consider most likely in the near term: a slow erosion rather than a sudden collapse, giving retirees and everyday savers time to adjust their own strategies accordingly rather than facing a sudden shock. For anyone managing a retirement portfolio, this scenario mostly means paying closer attention to diversification over the coming years rather than making any dramatic changes today. The second scenario: the pace of de-dollarization accelerates meaningfully, driven by continued high debt levels, political instability around the Federal Reserve's independence, or a genuine alternative payment system gaining real traction among major economies. Some financial analysts point specifically to the years around 2030 as a potential inflection point, where the dollar's reserve share could fall meaningfully further if current trends simply continue on their present trajectory, with some projections suggesting the share could drop into the 45 to 50% range by that point. If this scenario plays out, expect noticeably higher interest rates across the American economy within just a few years, directly affecting anyone with a mortgage, anyone carrying debt, and anyone counting on stable bond returns inside a retirement account. This is the scenario worth watching most closely if you are within a decade or two of retirement, since it would arrive on a timeline that could genuinely affect your own financial planning. The third scenario, and the one worth watching most closely given everything we just covered about Canada. More countries follow a version of Canada's approach, not necessarily rejecting gold entirely, but actively managing a diversified reserve strategy rather than either staying fully committed to the dollar or rushing entirely into gold. This middle path, spreading risk across multiple currencies and asset types rather than betting heavily on any single alternative, may end up being the more common response among sophisticated economies, even as gold buying grabs more of the headlines. If this becomes the dominant global pattern, the dollar's decline continues, but in a more orderly, less dramatic fashion than a full-scale flight toward gold would produce, which would likely mean a steadier, more predictable rise in borrowing costs rather than a sudden shock to the system. Whichever path unfolds, here is the pattern worth understanding, the same one that connects to nearly everything we have covered on this channel about the American-Canadian relationship. Countries that depend heavily on the United States, whether for trade, energy, or reserve currency stability, are increasingly hedging their exposure rather than assuming the old arrangements will simply continue indefinitely. Canada has done this with oil, finding buyers beyond the United States. Canada has done this with aluminum, selling into Europe during a shortage. And now, in its own quiet, technical way, Canada is doing this with its national reserves too, choosing a diversified currency strategy rather than assuming the dollar's dominance is permanent. Here is my honest read on where this settles. I do not think the dollar loses its reserve currency status anytime soon. The infrastructure and global habit built around it over the past 80 years does not unwind quickly, even with 68% of central banks now planning to buy more gold. But I do think the gradual erosion continues, and I think Canada's approach, quiet diversification rather than a dramatic gold rush, is a more realistic preview of how most of the world actually adjusts than the more dramatic headlines about central banks stockpiling gold might suggest. There is something almost counterintuitive worth sitting with here too. The countries making the most dramatic, headline-grabbing moves toward gold are not necessarily the ones with the most sophisticated reserve management strategies. They are often the ones facing the most acute geopolitical pressure, sanctions risk, or currency instability at home, which makes gold's political neutrality especially valuable to them specifically. Canada, by contrast, faces relatively little of that particular pressure, which is part of why its more measured, diversified approach makes sense for its specific situation, even if it generates far fewer dramatic headlines than a central bank suddenly buying tons of gold in a single month. The bigger point I want you to sit with is this. A retirement account built decades ago assumed a certain kind of stability in how the American dollar and American debt would behave over the coming decades. That assumption is not broken, but it is being quietly tested, one central bank decision at a time, in meetings you will never see covered on the evening news. Understanding that shift now, rather than being surprised by it later, is exactly the kind of foresight that separates a household that adjusts calmly from one that gets caught off guard when change eventually does arrive. So here is the question I want you to sit with. If countries like Canada are already positioning their own national reserves for a world where the dollar plays a smaller role, does that change how you think about your own retirement savings? Or do you think the dollar's dominance is more secure than this data suggests? Drop your answer in the comments and tell me whether you have ever thought about how your own retirement accounts are exposed to exactly this kind of shift. If breaking down exactly what these massive, slow-moving economic shifts actually mean for your own financial security is useful to you, hit subscribe, because this conversation about debt, the dollar, and how the rest of the world is quietly adjusting is far from finished. And if you have not seen our breakdown of how Canada has already been finding alternatives to American dependence in oil and aluminum, go watch those next. Because this debt and currency story is simply the largest version yet of a pattern that keeps repeating across this entire relationship. Thanks for watching, and I will see you in the next one.